You should constantly measure your performance, whether you're day trading, swing trading, or a long-term investor. How else would you know whether you're doing well? One of the most significant advantages of trading is the ability to objectively assess your performance using objective criteria. This may substantially aid in the elimination of emotional and cognitive biases. So, how does this help? To make sense of the world, the human mind tends to construct narratives around everything. You cannot, however, hide from numbers. If your approach is yielding negative returns, something has to be adjusted. Similarly, if you believe you're doing well but your data doesn't reflect it, you're most likely a victim of your preconceptions. We've spoken about risk management, position size, and putting a stop-loss in place. But how can you assess the performance of your investments? And how can you compare the performance of different investments? The ROI calculation comes in helpful here. This article will explain how to calculate return on investment, ROI. What is the definition of return on investment, ROI? Return on investment, ROI, is a method of assessing the performance of an investment. It may also be used to compare various assets. There are other methods for calculating returns, and we'll go through a few of them in the following chapter. For the time being, however, it is sufficient to grasp that ROI evaluates gains or losses in comparison to the original investment. In other words, it approximates the profitability of an investment. A good ROI represents profits in comparison to the initial investment, whereas a negative ROI signifies losses. ROI calculations apply to any kind of company or transaction, not only trading or investment. If you want to start or acquire a restaurant, you need first conduct some research. From a financial standpoint, would opening it make sense? Calculating your ROI based on all of your predicted costs and returns will help you make smarter business decisions. If the company seems to be profitable in the long profit, i.e., has a positive ROI, it may be worthwhile to get it started. ROI may also be used to assess the outcomes of previous deals. For example, suppose you pay $200,000 for an old exotic car. You then pay $50,000 for it and utilize it for 2 years. Assume that the car's market value rises and you can now sell it for $300,000. Not only did you enjoy this automobile for 2 years, but it also provided you with a significant return on investment. How much precisely would that be? Let us investigate. How to determine return on investment, ROI. The ROI formula is straightforward. You remove the initial investment cost from the current value of the investment. The total is then divided by the initial investment cost. ROI equals original cost, current value, original cost. So, how much profit would you earn if you sold the exotic car? ROI equals 300,000 to 200,000, 200,000 equals 0.5. Your return on investment is 0.5. The rate of return is obtained by multiplying it by 100. ROR. 0.5x 100 equals 50. This implies you earned a 50% profit on your first investment. To obtain the complete picture, you must consider how much money was spent on the automobile. So, deduct it from the car's current value. 300,000 to 50,000 equals 250,000. You may now compute ROI while accounting for expenses. ROI equals 250,000 to 200,000, 200,000 equals 0.25. Your return on investment is 0.25, or 25%. This implies that we may calculate your net profit by multiplying your cost of investment, $200,000, by your ROI, 0.25. 200,000 by 0.25 equals 50,000. ROI's restrictions. As a result, ROI is simple to grasp and provides a universal measure of profitability. Are there any restrictions? Sure. One of the most significant drawbacks of ROI is that it does not account for time. What is the significance of this? Time is, after all, a critical aspect of investment. There may be additional factors to consider, such as liquidity and security, but a 0.5 ROI in a year is preferable to a 0.5 ROI in 5 years. This is why you may hear some people speak about annualized ROI, which indicates the investment returns, gains, that you might anticipate over the course of a year. However, ROI does not account for other factors of an investment. A greater ROI may not always imply a better investment. What if you can't find somebody to purchase your investment and you're stuck with it for a long time? What if the underlying investment is insufficiently liquid? Risk is another factor to consider. An investment may have a high potential ROI, but at what cost? If there is a strong probability that it will go to zero or that your assets will become unavailable, the potential ROI isn't as crucial. Why? The risk of keeping this asset for an extended period of time is quite high. Sure, the potential profit might be huge, but losing your whole initial investment is not something you desire. Simply looking at ROI will not provide you with insights regarding its safety, thus you need also evaluate other indicators. You might begin by calculating the risk-reward ratio for each transaction and investment. This gives you a better idea of the quality of each bet. In addition, while examining possible investments, certain stock market experts may take into account additional criteria. Cash flows, interest rates, capital gains tax, return on equity, ROI, and other factors may all be considered. Final thoughts. We've discussed return on investment, ROI, and how traders may utilize it to make better investment selections. The return on investment formula is an essential component in monitoring the performance of any portfolio, investment, or company. As previously said, ROI is not the ultimate statistic, although it may be helpful. You should also examine the opportunity cost, risk-reward ratio, and other aspects that may influence your decision between alternative investment options. However, as a starting point, ROI might be a decent barometer for evaluating a possible investment. Thank you for watching.